when the news broke this morning on shortly after the opening bell that Mark Haines had passed, it was really tough to do anything but kind of stare at the screen. I found it hard to tweet about anything other than Haines this morning, and I don't think I saw a ticker sign for what felt like hours on Twitter. You've probably noticed by now that we're a little connected to CNBC. There's not a whole lot that goes on CNBC that we don't watch or talk about or cover or write in some story. I've driven my family numerous times to Inglewood Cliffs, to the NBC Universal Studios for live shows that they've had for Mad Money. We hope to be there in a couple weeks for the Mad Money. It's a family affair show again. It's a family tradition of ours. It's tough. What's interesting is we are not huge Mark Haines fans in the sense of how we feel about Jim or Steve or Guy or Pete or John or some of those others that we've been able to have on America's Favorite Traders. With Mark Haines, we were more tempted to put him on mute than we were to listen to him. That is until the Barney Frank interview that he did. And it was clear at that time that getting the truth out was really important to Mark, and that it didn't matter whose toes he stepped on to get you, the viewer, the truth about the financial markets and about the financial world and about what we were all dealing with. That was his only goal, and we really started to think differently about Mark after that interview. It made him a little easier to watch. His style was brash, but it was honest, and it was truthful, and it was real, and it was helpful. I think even now when we have the CNBC on mute, we'll still be able to hear Mark's voice. So we salute you, Mark Haines. We salute your work. We salute your career. We salute what you did for broadcast television, for the world of business, and most importantly, we salute you and the kind of family man that it's obvious that you are. The commitment that you had to those that you worked with. As we've listened today to so many anchors and reporters, it's clear that you had a huge impact on the lives of many, many people. And 9 o'clock in the morning it's gonna be a tough place to be for some time, and you'll be missed. So it certainly wouldn't be lunch in the market, and Mark certainly wouldn't approve if we didn't give you the trade, right? And so as difficult as it has been today, we did find some things to do today. A while ago we did a show in which we talked about companies that buy other companies, and now you're basically getting both companies for the price of one. Caterpillar buys Bucyrus. We like Bucyrus, and so you end up getting the Bucyrus part of the acquisition for free almost. The same is true with Ensco and Pride. Pride is a company that admittedly Karen Feinerman on Fast Money liked quite a bit as a standalone company, and then of course it was acquired by Ensco. So with the Ensco acquisition, you get Pride and you get Ensco for the price of Ensco. Another thing that we like is you can play a rising oil price, more drilling. Certainly as oil prices have risen, there's been a commitment from even some of the natural gas firms like a Chesapeake to become more oily than they have been in the past, simply because the economics of it makes sense. That's also a boon for the oil service sector, which we like a lot. Names like Schlumberger, which we've had a trade in earlier, Ensco, Weatherford. We've made some good money in Weatherford. So Ensco is a great way to get Pride and Ensco for just the price of Ensco. What's the trade? Of course, we like the in the money September 50-55 call spread, and you can actually get that for under $3 for the trade. That's fantastic. Normally we like to target under $3.80. Then that obviously our potential profit is $1.20. Comes out to around somewhere between 35% at the low end. If you can get something for, say, 360 or 350, you can get up towards 50% rate of return over the life of the trade. As it turns out, for getting it for 290, obviously your upside is $2.10, and that's about a 72% rate of return. So unbelievable risk reward, we think, in terms of getting long this September. 50, 55 in the money call spread on ESV. That's the symbol for Ensco. We like it for all the reasons that I outlined: rising oil price, increased activity in the oil service sector, drilling. The economics of drilling oil as opposed to the other carbon fuels have really made it very advantageous for people to do so. And so, of course, there's demand for the oil service sector. The other trade that we did came from Brian Stutland of Stutland Equities from last night's Fast Money, in which he talked about a hedge. A great way to hedge, and we do think it's a great way to hedge, is the in the money, the lower strike's in the money, the outer strike is not, the VIX call spread, the 16-20 call spread in June. Remember, everyone's concern is kind of the month of June, right? That's where there's a vacuum of economic news. We're more likely to go down in the absence of news. Seasonally, it's when we're historically weak. If you match up the charts from where we're at now to last year, we look like we're doing the same thing. We sold off, looked like we were starting to bounce, and then sold off again into the July lows. And so June's kind of that key month. Also, it's important to be in the front month in the VIX because the VIX on the out month trades differently than the VIX in the front month. And so the VIX that you're seeing on your screen, if you go out on the calendar and buy VIX options, they act a lot differently because there's actually a VIX that trades out at the next month that you're not really seeing in the price action of the VIX that you're looking at. When you type in VIX on TradeMonster, and you look at it, when you go out on the calendar and buy VIX options, you're not getting the kind of one-for-one almost that you would if you play in the front month. And so it's one of the shorter term trades that we do, but here's what's great about it. If you do, you should be able to do it for around $1.40 today. If you do, with the VIX trading around 17.27, then you're at almost completely intrinsic value. And so if the VIX does nothing, then you really come away with very little loss, or completely flat, or up a little bit, because you're already buying, the premium that you're paying is completely in the money. And so you're really getting your bang for your buck out of selling that 20 spread, the 20 side of the VIX call spread. So it's a great way to hedge. You're buying it for intrinsic value. You have until, I think it's June the 15th, he said. The VIX options, I believe, expire a little earlier. It's a great hedge. The other thing that I thought was really important about what Brian said was using 1% of your portfolio. And so what that happens is, let's say you pay $1.40, the VIX goes to above 20, it expires completely in the money, your spread goes to $4. That's a really, really terrific risk reward. And on the flip side, should you take a complete 1% hit on your overall portfolio, you can still have an absolutely fantastic year and see this hedge effectively go to zero and only take a 1% hit on your portfolio. So I really like the trade. I think it's a great way to hedge. Thanks again for tuning into us today on Lunch of the Market, and we'd really, really encourage you to keep tuning back every day to get our trades, and even more importantly, tune in tonight, 7 p.m. on CNBC to watch the tribute to Mark Haines. He's a great man. It's a tough day for those out there that watch CNBC quite a bit like we do, and Mark, you'll be missed. Thanks again for tuning in again today, and we'll see you tomorrow.